Q&A session, baby. Let's go. So many of you have been asking me about why I sold off my real estate investment trust, such as a Riocan, my thoughts on these new growth stocks I've been buying, along with my thoughts on the general economy, where I think we're going, things I'm seeing on the street. If that's a conversation you'd appreciate, I love those comments from you wonderful passive income investors. Always suggest something down below because I do read them on the regular. So let's get right into this with first and foremost, guys. This is coming to you from Investing Grind. Hey, man, how long have you been holding VDY? If you were to start over, would you just own VDY in your TFSA? The question to that is very simple for me, maybe not for you, but that's an obvious yes. Taking a look at my TFSA, guys, right now I've got about $58,000 in VDY, and since the early inception of my investing, I only really held Canadian banks and Canadian dividend stocks. This auto weights the best of them, like Royal Bank, TD, all that stuff, right? But the thing is it doesn't hold those growth stocks like Shopify, so you could be missing out on some upside potential. But for me personally, I am just a Canadian dividend focused investor from that aspect of my portfolio, and this is currently the only Canadian dividend stock I hold in my portfolio. But do keep in mind, most of my TFSA money is in the US markets like VO, SCHD, and Taiwan Semiconductors, that new position that I recently added. Now, Stewie says, did you have a video to explain why you sold your REIT? I have 15% of my portfolio on it, and I just want to know why you sold. Stay awesome. So when it comes to the real estate investment trust sector, guys, this hits kind of close to home from an income-based perspective, because I told you that I don't want dividend income to be the primary focus of 2023 for me. I want income, but I also want equity growth. So I'm trying to find those stocks that pay good yields but have good growth, and Riocan just does not fit that suit. Now, keep in mind, I do have exposure to Riocan with my fiance and my family. We hold a lot of these stocks that, though I don't hold them in my portfolio, we largely overweighted them because my fiance has a lot of Riocan. I held a lot of Riocan. The problem is this is an income-focused asset. So if you're at that stage in life where maybe, GICs, bonds, real estate investment trust, or higher yielding companies is your focus, then I think Riocan is a deal. I think it's an incredible buying opportunity if that's all you want out of your portfolio. For me, I do want some growth, and I don't want to be too overexposed to companies that, yes, pay really stabilized high yields, but don't offer that kind of growth vector behind them. So that's why I sold, obviously, things like Smart Centers as well. But what are your thoughts on Slate Office REIT? It has been paying a solid dividend for years. It seems to be a good one. So office REITs scare the crap out of me. I was recently just visiting San Francisco last year, and their offices are closed like crazy. Coming from somebody that works from home that doesn't want to go to an office, coming from someone like my fiance who only goes to an office now once or twice a week for her job, I just don't see myself personally feeling comfortable holding office REITs. I think most of them are abysmal, but then again, you look at Slate Office's tenants here like CIBC, Bell, the Canadian government, and you could say, hey, these are resilient tenants. They're never going to shut these office buildings down. Then that could be the investment for you. But I personally love the idea of Slate Grocery REIT, same company, a different aspect of investing. This is primarily focused on the U.S. Grocery market. So, it doesn't matter whether you're Uber eating your groceries, you still need a grocery store, and they're highly recession proof. And this one pays well over 7% and has actually offered some pretty good equity growth. In fact, I still consider buying this one, but for now, I just take a look at it and as I focus on other companies. But Fit BH says, why such a high portfolio weighting to TSM? Why not a growth ETF and a few other beaten down individual positions? Spread the risk a bit. So firstly, when it comes to the growth ETFs, whether it's ARK Innovation, your NASDAQ 100 QQQ ETF, I don't like them. I feel like they overweight a lot of companies that are overvalued, but then you get some exposure to things like Meta, which I think are largely undervalued. And honestly, I think when it comes to growth right now, because of how skewed the market environment is, that I think I'd be happier owning the individual positions. From a portfolio weighting standpoint, TSM is only 5.2% of the portfolio. In fact, VDY, because the weightings are so large, and Royal Bank making up like 13% of this ETF, actually Royal Bank is a huge and the largest position in my whole portfolio, but now TSM is kind of second in place. I don't want individual stocks making up much more than 10 to 15% of my whole portfolio. Ideally, I want TSM to get to about maybe, I can say 6 to 8% of the whole portfolio, and then I might look to add one more like Apple or something that I can upper weight that also kind of complements VOO. But again, I'm still waiting to find that position when I think the value is there, because I still think Apple could drop a little bit more. But comparing TSM, for example, Taiwan Semiconductors, if you don't know what it is, it's basically the monopoly that pretty much every chip in your house operates from to some varying degree. They make up over 50% of the chip market. Apple can't function without them, basically. We can see that if you compare it to a dividend stock like Johnson & Johnson, which is a favorite amongst the dividend investing community. If you go all the way back to basically 2014, there hasn't been a whole lot of growth out of Johnson & Johnson. Yet the stock has gone up. The PE ratio has gone from an average of like 15 to 16 to where it sits today at like 20 to 25. And people are so giddy about this company, and I don't really understand it, because if you do a comparable to Taiwan Semiconductors, here's a company since 2016 has massively grown their bottom line EPS and cash flows. The PE ratio has fallen off a cliff and has returned back to its 2016, 2017 pricing points, and the stock is trading at a very favorable value. You can start understanding why I've been choosing this stock, because it gives me exactly what I want. It gives me income, incredible dividend growth, and it gives me equity growth on top of that. So I don't feel like I can lose with this position, though keep in mind there is obviously risk with buying any individual stock. As FitBH also asked, I think you'd be better off going into SMH, which is the Semiconductor ETF. Now, the primary reason I won't buy this ETF is because it's pretty much all reliant on Taiwan Semiconductors. NVIDIA, Broadcom, Intel, Texas Instruments, Qualcomm, Micron Technologies, a lot of these have a high reliance on Taiwan Semiconductors being able to do what they do. In fact, if ASML or Taiwan Semiconductors went under tomorrow, and this is the reason I think they're the most valuable companies on the planet, we'd be so royally screwed. This is why you're seeing the US, Joe Biden, the likes of Apple all show up to that big event where Taiwan Semiconductors is investing $40 billion into manufacturing in the US, because the US barely makes up, like 10% of the entire global semiconductor industry. So they need some diversification from like a risk profile. This is why China wants to invade Taiwan. I mean, that's why I keep hearing questions like, what will happen when China invades Taiwan? There's enough saber rattling to make me think that TSM may be a risky bet. And this is my exact opposite thinking. I think Taiwan Semiconductors has so much value to it. It's not only why China wants to invade, but it's also why the US wants to protect Taiwan. And I think this thing is a true golden gem, and it comes with the same kind of risk associated with owning, say, Alibaba stock or Tencent. And for me, it fits my risk profile, because I really just don't think it's going anywhere, even if China invaded, which I think the media has largely overblown and isn't going to happen anytime relatively soon. Could happen, but I don't know. I'm not going to I'm going to do the Warren Buffett thing and try not to play the political stance and just focus on good companies and let political stuff do what it's going to do, because it's always going to be surrounding companies. Those companies I don't think are going anywhere. Armenian Heat says, there is not a damn recession. Been saying this all of 2022. Enough. Houses aren't crashing. People aren't losing their jobs. Load up on stocks. Don't get scared. Media is just scaring people. They want to bring down the stock market so they can buy cheap shares. And I do agree with this to some extent. Firstly, from the housing market perspective, housing is crashing depending on where you live. Where I live, I've seen homes go from 1.2, 1.3 million to about 800,000 over a 30% correction. And I've talked to a lot of realtors in Toronto, where Toronto's been a little more stabilized, but even those realtors said luxury real estate isn't selling. Anything over $2 million, not moving at all. I'm seeing it in these areas where I live, where homes that are listed for 4 to 5 million, they haven't moved in months. Yet if you're buying regular homes, though the volume's dried up by 50%, regular homes are still selling, and we're seeing a mild correction in the housing market across the whole spectrum of Canada right now. I don't know about the US, but when it comes to stocks as well, yeah, I talked about this over the holidays when I went to Best Buy. There was such an overglutton supply of TVs, computers, all this stuff. I noticed me, Kevin, discussed this, yet no one really followed up on it. So I've been going back to Best Buy at the beginning of the year to really see if they would lower prices even more than Black Friday. And in fact, they got rid of a lot of the inventory. I was kind of shocked by that. And, Apple was always packed. I'm still seeing nothing like, you go back and you look at the 2008, 2009 Black Friday deals and stuff, and people weren't really lined up at the stores like they were this year, I think. So I think we're going to see a relative soft recession, because as mentioned with jobs, I'm hiring people right now, tech jobs. When people get laid off, their turnover on finding a new tech job is actually relatively quick. So the economy still seems pretty good from a job standpoint. So I think, again, like you're mentioning, it's setting up for a huge buying opportunity in individual stocks. This is the year we become millionaires, because stocks are getting so suppressed. You buy now, come back to me in 3 and 5 years. If you're buying the right things, I think you're going to be very happy with those decisions. A final comment, Justin Dufour says, part of the 0.4%, I'm 17. He's relating to a video video where I revealed the age of the average person watching my YouTube videos, and 0.4% of you are like under the age of 20, which blows my mind because at that age, as I mentioned, you can invest in just about anything. And so long as you're diversifying and constantly buying, you don't have to care if the markets are overvalued or undervalued because you have decades for that to sort itself out. You're from Coutinho, if I'm saying Coutinho, if I'm saying that correct, from Quebec, and I've been sorry if I butchered that. Been watching every day for 6 months. Absolutely love the content and insights that you give. You definitely deserve much more subscribers and views. Keep it up and look forward to next year's content. Thank you, thank you, thank you. And I love seeing all the wonderful comments below. Sounds like there's a lot of you Canadians that live relatively within means to each other. But I'll pass the question off to you. I'd love to know what you guys think about all of this in that comment section below.